Great. So I'm getting the cue that we have, actually we can see here on the bottom, we have about 60 people joining from all over Southeast Asia, Australia, and the US, I believe. So I wanted to have a warm welcome to everyone. Thank you so much to the attendees for joining. Good morning for those in Southeast Asia and Australia, and good evening for those in the US. And of course, thank you to our panelists, all 12 of them who have agreed to graciously spend their evening with us. So yeah, without further ado, basically this, the context of this panel is, or I'm calling it a roundtable discussion because we want to hear a bunch of different views from different people in the APAC region and cross-border startups as well, about how they're adapting to COVID-19. Obviously, this global pandemic is, wasn't expected by anyone, and it's caused a huge wave of changes, and not just socially but in business as well. So really interesting lineup that we have here tonight to talk about how VCs, we have VC. I'm gonna do some housekeeping just to let everyone know. Move on to the next slide. Great. So all lines have been placed on mute to prevent background noise. To hear the presentation clearly, please turn up your volume on your computer, and the chat function will be disabled, but you can submit any questions to the Q&A panel. So someone here, I think Janssen, will be helping moderate the Q&As. And I think feel free to ask questions throughout the roundtable discussions. We aren't doing a Q&A in the end. We want this to be a lively discussion, so we would take questions along the way, and if you have someone on the panelist you want to address it to, please note that as well. This roundtable will be recorded, so we will send a link to everyone after the session. So please note that as well. And next slide is basically an introduction of all the panelists that we have today. And I will let everyone introduce themselves for a quick 1 minute and a brief intro for what they do. You want to, Janssen?
Sure. Hey guys, thanks for coming in, everyone. As you guys know, for some of you guys, I've been mostly running engineering for the last 3 companies and startups, and in between I've been doing a lot of consulting. In the last couple of consults, I guess I've had, one was for a company called Grab, which I'm sure most of you know. And then after that, most recently, actually, I'm also consulting a little bit for MDEC. And MDEC really is the Malaysian Digital Economy Corporation, and they basically take care of everything digital in Malaysia, everything from the laws to grants, and really, pretty much everything in support of the economy. So anyways, happy to help if there's anything I can help with, one. And secondly, I guess most relevantly to this conversation, I am also a founder from that perspective. And, I'm in this position where I'm trying to figure out, do I start going for my next company, or, do I go get a job because it's safer? So very interested to see what's going to happen and, have the conversation. Thank you. 1 minute. Eddy, do you want to go next? And I think we should probably just go across, if you can sort of see the speaker slide from top left all the way to the right and down next.
Hey, so thanks again, everyone, for joining. Really appreciate SVB, MDEC, as well as Janssen for putting this together. My name's Eddy Chan. We run a firm called Intudo Ventures. As far as we understand, it's the only Indonesia-only early-stage fund globally. We back Indonesian headquartered companies founded by Indonesians. For the most part, some key portfolio companies in our portfolio are Zendit, Halodoc, a lot of the category winners in Indonesia. We run a hyper-local operation in country. Everyone on the team's Indonesian, outside of myself, and we pair that with 24/7 coverage in Silicon Valley. So we're backed by about 25 of the most prolific VC funds globally, and we act as their Indonesia beachhead strategy. Prior to founding Intudo, I've been a founder for many years and also a venture investor across Silicon Valley for about 20 years. So early on, we did PayPal, SpaceX, Palantir, then certainly in China and today in Indonesia. Thank you.
Tiger, you want to go next? Oh, he is joining later. Shao-Ning.
Okay, I could go next. My name is Shao-Ning, and thanks for having me on the panel. I think Binh introduced me to this, and I think everybody's a fresh face for me. So very quickly, my background, I was a startup founder for the first 14 years of my life. I've only recently transitioned to become an angel in the past 4 to 5 years. So after I exited the business in 2012, I focus a lot on supporting startups in my portfolio life. And I realized that one way concretely beyond helping them actually financially and using my time is actually to bring together a group of angels who can do it together. So I see myself as a node. If I can bring more nodes out from Southeast Asia, I think that's a point that I can help using collective resources. Personally, I went through the SARS in 2003. I went through a great financial crisis in 2008, but I think this is the first world pandemic that you actually stop the churches from happening. And I think it's actually quite a nice feeling that, I mean, not to make any stress feel bad, but I think it's a good wake-up call on how the founders could actually see the situations differently, see the valuations differently. Yeah, so hopefully to learn from everybody's insight today. Thank you.
Ms. Desmond. Oh, you're muted, Des.
You're muted.
All right. Hey, everyone. Can you all hear me now?
Yeah.
It's good now? Okay, perfect. Hey, everyone. Desmond here. I'm one of the founders for this work stream. So it is this end-to-end hiring software that is built for restaurants, hotels, healthcare companies, and more. So I think I will have quite a bit to share today about in terms of this impact on some of my clients. I have also just raised a round of this Series A. Very glad to share more on that too. So just a bit more about me. I'm from Singapore, but I've been based in this actually SF for the past few years. So I founded my first business right after high school to pay for college. When I was in college, I founded this Thai food restaurant before I sold it. And then went out to join Merrill Lynch and came to the US in 2013 when I went to MIT and this Harvard before moving out to the Bay Area in 2016 and building my current company. So yeah, so very glad to talk everything from startups, from this career path to some of this impact on some of our current clients. With that, I will pass that to Geoff.
Thanks so much, Desmond. My name is Geoff McQueen. I'm one of the founders and the CEO at Accelo. Accelo is a B2B platform. We run operations for service businesses from quote to cash in one place. COVID's been an interesting impact because almost all of our customers are small businesses, and they've definitely been hit very hard by the really dramatic shutdown of most of our economies. It has been very heartening, though, to be able to help them. We saw our usage go up by about 20%, not quite Zoom level numbers, but from our existing customers, their usage of the product went up with 20% in March compared to the prior months. And they definitely use our product to run their business. So everyone's been working on how to sort of be remote as it relates to being a remote team. And now folks are starting to come to terms with, well, what does it mean to really run my business and understand profitability and utilization and what's actually getting done? So it's great to be able to help people in tough times. So yeah, I've got some perspective. We've raised 11 mil. Our last round wasn't for a while. It was a while ago, but that certainly means that if we were going to be going out to try and raise in a traditional sense, things are quite different now. I've had a few conversations with VC friends and peers to get a feel for their market, and happy to share some insights and perspectives as well.
Oh,
Hey everyone, I'm Lennise. I'm the CEO and co-founder of Dropee.com. What we are doing here is we are a SaaS-enabled marketplace where we help connect fast-moving consumer goods brands, wholesalers, and distributors directly to their retail customers through a simple B2B ordering platform. And I'm more than happy to share what's going on across Southeast Asia and Malaysia within this industry and space.
Hi everyone, my name is Quan Pham. I'm a CEO and founder of Pi.Exchange, based in Australia. Pi.Exchange is a SaaS platform offering full service, end-to-end service for AI application development and operational management. It's a tool for user of all shape and size, of all kind of technical ability to easily and affordably build your AI for business growth. So we focus on, simplify the technology, reducing the cost, and bringing a delightful user experience for our users, so that, you can easily extract predictive insight from the data. For me, I moved to Australia from Vietnam for about 20 years ago. I used to work in very kind of like a number of different kind of capacity, mostly tech. My background is that I work as software engineer, cybersecurity consultant, on the way into like, IT exec kind of level position. Found a Pi.Exchange about like 3 years ago. And has been kind of like, expand from Melbourne to Singapore and Vietnam. We still have a fairly small team at the moment comparing to other people's here. Really keen to got a chance to learn from you guys and share some of my experience in dealing with the COVID-19 as part of the conversation today. Thank you.
Hi, I'm Ernest, co-founder of Veryfi. We're based out of Silicon Valley. I'm originally from Sydney. This is my second company, actually, venture-backed in America. Veryfi has been around for about 3 years now. We did the whole YC program back in 2017. And Veryfi is basically building software for project-based bookkeeping automation. It's been an interesting journey in my Silicon Valley time frame, which is about 10 years here. When I first came out to Silicon Valley, I actually came out during the recession in 2009, and it was also the H1N1 pandemic, as I learned a few months ago. But I worked for a unicorn company which acquired us. So I've got some interesting stories to talk about that. How they managed through the whole recession and what happened after. And I think that's sort of, from a founder's perspective, there's a lot of, I'm very optimistic about what's going to happen when we come out of, whatever this thing is called. I don't want to call it a recession yet, because a recession is typically 2 quarters in negative growth. And I don't think we've got the data yet. But it's definitely an interesting time, to sort of be running a company. Now, in terms of Veryfi, just a couple of other things. So we're a profitable company. So we don't really rely on venture capital anymore to sort of fuel the business. And we have delayed our Series A fundraising for a number of reasons, which I'm sure we can talk about later.
Hi, my name is Tran. Good morning and good evening to everyone. Thank you, Cheryl and Silicon Valley Bank and Andy for hosting this. And thanks for having me. I'm general partner for 500 Stars of Vietnam. We are an American fund investing in the growth of Southeast Asia, in particular companies with a Vietnam connection. That means we have companies both in North America as well as Vietnam and Southeast Asia. We're the first Silicon Valley-based fund, early stage fund in Vietnam. We have completed over 60 investments. We're the most active investor in Vietnam. Prior to investing, I've been through a couple down cycles, the dot-com boom, as well as the great financial crisis. Those 2 times as a founder in Silicon Valley. My last company, you may have heard, a company called Clout. We're known for the infamous Clout score. But yeah, we'd love to learn from this panel and share some of my thoughts. Thank you.
Hi, everybody. My name is Vu Van. I'm the founder and CEO of ELSA. And we're based here in Silicon Valley. And what we do is we build an AI that uses voice recognition technology to help language learners around the world improve their English pronunciation, with the hope that everybody can speak better English and more confidently so that they can get better opportunities in their lives. And I started this company about 4 years ago, and it started out of my personal challenge as I moved from Vietnam to the US here. And speaking English was a big issue for me in gaining the confidence and the opportunities here in the US. We actually, Binh Tran from 500 Startups in Vietnam is among our very first investor and had been a great support for us ever since. And so the COVID-19, actually, so far, we're very thankful that we're actually in a more lucky position. The impact has been more net positive for us with online learning. And so we can share more about what it means for us. And we're also in the process of doing a fundraising right now for our Series B. And so can also share with you the process of what we are going through and what we see right now with the fundraising market right here in the US. Thank you.
And last but not least, Andy, you want to kick us off with a welcome?
Well, thank you, Cheryl. Good afternoon, everybody from California, and good morning for those of you who are joining us from the Asia Pacific region. I'm Andy Tsao. I'm a managing director here at Silicon Valley Bank and head of our global gateway business. Thank you for joining us for what is our second Zoom targeting APAC, while representing the 6th in our Global Gateway series of webinars. In fact, just yesterday morning, we did a session for Australian and Kiwi founders on managing currency risk. First and foremost, I hope that you and your families are safe and healthy, and that you're adjusting to life in a shelter-in environment. For me, the boundaries between family and professional life have disappeared, and each day seems to blend into the next. On that front, it's the new normal that kids and dogs often wander into our background, so don't be surprised if that happens today. We are in unprecedented times, and there's a lot of uncertainty out there, both personally and professionally. The human cost has been terrible and mounting, but the recent data suggests that the shelter-in-place restrictions are making a difference here in the US. Much of Asia Pacific is in the same lockdown, and encouragingly, some parts of Asia are actually beginning to reemerge from the shutdowns, giving us some inspiration here that the restrictions can keep the pandemic in check. At SVB, we are open for business, and we're here to support our clients and our partners as we go through this crisis together. In the US market, we've announced several programs to support our clients, including processing the US government care and payroll protection program over the last 10 days. For those interested in more information on those programs, I would encourage you to go to our website. We've been through multiple cycles through our near 40-year history, and we have a good understanding how to navigate downturns. Personally, this is my third at the bank. 2000, the internet bubble, 2008, spurred on from the global financial crisis, and now this one. There are certainly similarities in terms of how the environment seemed to change overnight, the anxiety and the sense that the sky was falling. With the benefit of hindsight, of course, the innovation economy was able to not only survive, but went on to decades of unprecedented growth. The slide on the screen certainly illustrates this point. Yes, there were downturns along the way, but the overall trend for the tech and innovation economy has been very much up and to the right. Yes, these are uncertain times, but we at SVB are optimistic about the future of the innovation economy. And having done business development in Australia and Asia for more than a decade, I'm incredibly optimistic about the medium to long-term future of the APAC innovation economy. However, today we find ourselves in most challenging times as we try to navigate the effects of the pandemic. Difficult decisions will be made, and some good companies will suffer. At the same time, entrepreneurs deal with uncertainty all the time, and in many respects are well equipped to handle the adversity, particularly entrepreneurs from emerging markets where challenges are routine and often present tremendous opportunity if you can solve for those challenges. After all, as I say in our business, the best tech companies were built during the most challenging of times. Just look at Google and Amazon from the dot-com bubble, and Airbnb and Stripe from 2008. Again, the slide illustrates this point. I have no doubt that some of you on the Zoom today will be creating the next generation of great startups in APAC. So let's get the discussion started. I look forward to hearing the insights and perspectives from the terrific speakers. Thanks to all of you for being part of our program today. Thanks, Cheryl, for pulling this together. And thanks to Janssen and Horizon Connect for being a partner with us. Cheryl, over to you.
Thank you, Andy. So I know that Desmond has something to share about how his product is serving customers and what he's observing, because he serves a lot of small businesses and restaurants, and he has to leave at 6. So I'll let him share his views first. And congratulations, he just closed a $10 million Series A round in Q4 of last year. Luckily, you did that right before the pandemic. But yeah, feel free to kick it off, Desmond.
Yeah, thank you so much. First, I'm gonna give a quick actually shout out to Binh Tran, because he was also one of my early angels who has been very helpful. So thank you, Binh. Yeah, so we closed our 10 million Series A actually late last year. So we are in a spot that is very lucky. We were actually able to get 6 term sheets in the space of like three and a half weeks. So things went very well. So we picked actually Founders Fund in the end, which was followed by CRV, CEO for Zoom, CEO for DoorDash, JV, and more. So it was a fairly strong round. So very glad to talk a bit more about that. And I've been trying to talk to other founders who's been thinking about trying to fundraise now too. Should I talk a bit about that first, Cheryl, or should I talk a bit more about this actually restaurants hiring?
Yeah, I mean, I think it'd be good to share about, like, because I know a lot of founders who submitted questions have questions about, like, should they be fundraising now, or like are you seeing valuations go down, that kind of this kind of stuff. So as far as that is concerned, maybe you can share some of that and then jump into how your customers are dealing with it.
Yeah, and I think I'll add one thing, Desmond, if you can also touch upon, given that you have raised a significant amount of money just before what is actually a very big downturn, how's your outlook with regards to how aggressive you're going to be in this particular period, given you actually have a war chest that can use? Yeah,
thank you for that. I think those are both very, very good points. Firstly, just touch a bit on what Cheryl was saying. So I think, yes, people are still trying to raise funding, and yes, I think VCs are still trying to write checks. So all that is true. We definitely see the price of the rounds coming down very much. That is what we see. It's almost like a 30% to actually 40% cut from when it was at its peak prior to this virus. So that's something that we see. So it is also getting harder for actually VCs and founders to connect, because people are not having to meet face-to-face. They are doing it over Zoom, right? So when I talk to other founders from this founder's point of view, try to tap upon people that you know, people that you have met in the past, right? Because it will be harder to build trust with someone like virtually over Zoom as trying to compare that to someone who you have known from the past. So that's the first point. Second point to make on whether or not you should fundraise or not, I think that is based on how much runway that you have. If you have more than 1.5 years runway, then I would say, yes, hold off if you can, right? But not every company has that choice. If you have less than 12 months runway, then I say, yes, let's try to fundraise. So I think that's the quick answers that I have to some points that actually that were asked. To the second point as to, since we just had our fundraise, how am I trying to manage the cash? We are being very prudent, right? As a team, we have always been like very prudent from the start. We have always tried to manage our cash flows well. So things haven't changed for us. We are trying to grow, but we are not trying to burn a ton of cash in order to grow, right? So yeah, so that is what I would say. On our end, we are trying to grow it in a way that is actually prudent. So yeah, hope that is helpful. Yeah. Yeah, any question other than that on the part on fundraising? Happy to touch a bit more on that or go into the trends that I see across hiring for this restaurants and this hotels. Cheryl, should I do that or
Yeah,
what are your thoughts?
yeah.
Perfect.
Please jump into
Good.
it.
Yeah. So in terms of
So I
hiring
guess work
across-
stream. Yeah, I guess you want to. I don't know if you mentioned earlier, but Workstream helps small businesses hire temp workers, right? Is it?
Yeah. So let me jump a bit on that. So what we are working on is called Workstream. So it's an end-to-end hiring software built for restaurants, hotels, healthcare companies, and more. And today we have a few hundred brands from Jamba Juice, Subway, Hala Guys, Westin, Merit, and more. So we have a very, very broad range of clients across various sectors. So we've been able to see a lot of really good trends in terms of who is hiring and who are not. So I would say that yes, many sectors like restaurants, hotels, they are not hiring, but there's also some other sector they are still trying to hire. If you think about healthcare, supermarket, gas stations, warehouse, companies that are trying to hire drivers, those are still hiring, and those are trying to hire more, right? So I would say that in the past few weeks, trying to compare April versus February, we've seen almost like a 3x growth in terms of job postings for this actually drivers, and we are seeing a 2x growth in job posting for this actually nurses. So
net on your platform, all hiring has been up actually, not down.
I would say it's been flat overall for us, right? So many companies are not hiring, like I said, but there are some companies which are hiring and they are hiring more. So that is one of the trends that we see. And some of this local businesses, they are actually booming. We have this supermarket chain. They are trying to almost double their crew in this 3 weeks. So that's been really hard for them to hire many people, right? So that's one trend that we see. On the other hand, though, for those restaurants, hotels that are closed, we see they are really trying to struggle, right? About 70% of them are closed, and those who are open, they are trying to pivot their current business model. Some of them have went from B to C into B to B. For example, one of our clients is called Cooper Cafe. It is based in Palo Alto. They have a chain of about 10 stores. They have started to go towards B to B, selling to Stanford Medical Center and trying to send food there for about 50 people every day. They have also started to pre-sell gift cards to some of their current base of clients. So we surely see a trend, and we see a lot of this changes and this pivot even among some of these local SMEs. Yeah.
That's super interesting. Yeah, that's I was on a webinar like last week as well, and then was also trying to mention how some startups are creatively pivoting their business models to meet the market need right now. So thanks for sharing that piece. Is there any other insight? I know you have to go at 6 that you wanted to share before you leave.
Yeah, I'm very glad to share more. So I think those are some of the trends that we see. I think maybe I can share just a few more trends as maybe relevant to the group over here.
Yeah, just a couple more, because I know we have so many people, so many panelists. Yeah. So maybe just a couple more points. Thank you.
Yep, that's cool. So there's a few trends I see very quickly sharing is that our view is that people are going to work from home more after this whole virus, and actually businesses are going to cater to their needs in terms of like restaurants, hotels. That is a trend that we all see now, right? And we also see a trend where there will be much more hourly workers. We see a trend whereby businesses are less open to hire full-time people right after this, but they all want to hire. They are going to hire more of this actually hourly folks. So there's two clear trends there. There'll be more people who will work from home, and there'll be more hourly folks. So I think that gives a lot of room for people who is on this talk to think about what are some business ideas that we can build to actually cater to these two groups of people who are growing.
Right,
Yep.
right. Excellent. Thank you so much for sharing, Desmond. Great views there. I actually want to jump to Quan for a second, because I know, you know, your situation is a bit tougher, right? Where I think you had to do some adjustments to your employee count or let some people go. So that's a very interesting and hard decision to make. Would you mind sharing a little bit about that? And I think you also had to postpone raising a round because you didn't want to raise on bad terms. And Ernest, feel free to chime in after, because I know you're in a similar situation post-moting your round as well.
Yeah, thank you, Cheryl for the question. So to give you a little bit of, and everyone a little bit of background on where we are in terms of where we are, right? Of course, we are probably compared to like other staff or company in the panel today, we probably not so much as the youngest one, but we're probably in the earlier stage comparing to other people, right? So kind of like we're also not in the lucky position where we already like raise a big round or something like that. We still pretty much in the early phase. We still have to kind of like generate more traction, and we still have to raise more money. So obviously, this kind of like COVID-19 thing is a kind of like a black one event, but it's really not helpful for us as many other people here. So like you say, it's right. When things happen, we need to take some very kind of like discipline and drastic measure to actually try to be have a appropriate kind of like set action, as well as try to stay on top of the situation. And yes, you're right. We kind of like when we look at this, right? We at the same time we try to grow. We try to be able to like in the middle of something. We're gonna launch a new set of service offering for especially targeting people that like a setup self-service AI tool for people who work remotely and collaborate in a collaborative way, for example. So we try to balance between the fact that we can't really just rely on the own plan of like increasing headcount and try to meet on the demand in terms of marketing, in terms of product development and that sort of thing. But at the same time, we try as much as possible not to harm the effort to get there as well. So my kind of like work, which is like I think very similar to other people, but I guess in my case I have to look at and balance between try to be very disciplined on the spending, as well as try to get the help from the outside, right? So in the middle of this one, in Australia, the government has provided a number of like support package, and lucky enough for us is that we can enjoy some of the benefit from there as well. On top of that, we try to kind of like, and the team has been working very hard because they understand the situation. So despite that, we have to cut some contractors and headcount that probably not very much essential to what we try to do as of today. The impact so far is not probably too bad. Also, I think for us, the fact that we are well prepared with the work from home situation, our infrastructure, our way of working has been willing to work that kind of situation or this situation for like more than a year. We've been very productive so far. So when this kind of like situation happened, we've been well prepared. And it's not like for some other company where they have to do a lot of transition and prepare their employee. We kind of like very nimble and we can switch things very quickly. Mm-hmm. So that has been a good thing for us, and cutting some of the headcount, while it's hurtful, it's probably not impacting as much as we thought it should be. right?
Do you
The
mind
second
sharing
point
how much you cut in percentage wise or number wise?
Yeah, so percentage-wise, we reduced the headcounts about 10%, targeting like mostly contractors and people that provide non-essential or non-core product development kind of things. So we're looking at like, you know, web development, for example, and that kind of like, you know, peripheral stuff. And on top of that, we also, you know, for the management and for myself, for example, we look at like, you know, other financial measure like, you know, salary deferment, as well as reduce, you know, kind of like accept that we have to take a small cut on our salary as well, just to make sure that we can move through this one. Also, I think, you know, the other thing that I would like to add is, on top of that, I'll try to look out with other partners, like, you know, we have a partnership with NVIDIA, with Google, and they provide some assistance, you know, in terms of infrastructures and that kind of thing, and it helps us to make some good decisions around, you know, what is a cost-cutting measure that we have to employ as well.
Interesting. And if you don't mind sharing, like, you know, is 10% enough? Do you think? I mean, like, you know, what's your outlook like?
Okay, so I think, you know, I never know, to be frank, right? This whole thing, people say, well, you know, some people say it's gonna last for like 12 months, some people say, you know, 1.5 years. Typically, you know, try to survive as long as we can. That's probably everyone says that. So whether or not this 10% is enough, to be frank, I don't know. What I'm trying to do right now is that I try to push the limit, you know, as much as we can, to the point where we can see that we still can do some meaningful things, but at the same time be very much disciplined, you know, I mean, like as much discipline as possible in terms of the spending. So so I kind of like saying is that, you know, in a way, I'm still quite a fairly optimistic guy, and I think, you know, there's a good chance where we still can find some, you know, still can generate some traction and grow in amid this kind of thing, because I think, you know, the area, the market, and the stuff that we do still generate quite a lot of interest, even between, you know, like the B2C and B2B market. So so I think, you know, just speaking personally for Pi.Exchange, I think that probably, you know, what we can do is sensible for the current situation. We do looking at, like, you know, reviewing that every 2 weeks and try to be kind of like, you know, on top of the situation, and I think, you know, we would just try to do the you know, kind of like sensible thing, and be very much keep a close eye on the recent developments.
Yeah,
so,
I've heard some companies too, like they that, you know, they don't have as many contractors to cut off because they are at Series A or B. What they do to try to prevent layoffs is they move everyone to a 4-day-a-week kind of schedule, so they're working less and their salaries are cut accordingly. So that's kind of one strategy, just to share that you can apply if you are in that situation. I want to actually move on to.
Can I just add another strategy?
Yeah,
to that?
yeah.
I think
I was just going to let you speak. Yeah.
Quan mentioned it very briefly, but reach out. Like you obviously have, yeah, all startups have expenses, right? But reach out to any single partner, like your AWS, right, for web hosting, or Google, whoever is web hosting, and tell them, have you got any program for, you know, to help us with any sort of discounts? They do give discounts. I've managed to get discounts from Intercom. There's a bunch of other companies, AWS, right? Just reach out to them. There's actually a lot of startups doing that. There's a lot of discussion around that in Silicon Valley. Maybe it's more around the YC community, but you can actually reach out to AWS, Google, Intercom if you use it for, you know, for communicating with your clients, Google Apps, and ask them for a discount, and they'll be more than happy to give it to you. If you don't, you never get, right? So it's better to ask. And I think everyone understands the situation every startup is in, and a lot of the large companies understand that, you know, startups are the seeds of the future of some large company, right? And so if they don't help the startups out today, these companies might not exist in the future, and therefore their revenues might also be impacted. So they look at it as a future investment by giving you a discount. So that's one of the things you should do straight away. I mean, every startup should actually do straight away.
Yeah, I agree with you. Actually, I think the key point is that asking for help. Don't be afraid of like asking for help, right? And ask everyone. I think in this situation, especially when you are a young and small company, there's no shame of like just kind of like try to seek help. And I think I try to do that in a holistic way. I mean, it's not just like looking at, of course, the salary and the spend. Like for staff is the biggest kind of like item that we need to look at. But I try to look at it in a very holistic way, where we look at we talk to government, we talk to even like our landlord, for example, we negotiate to kind of like reduce the rent, and they're very open to have that conversation. Even though we're in the middle of the contract, right? So there's no kind of like term or condition that allow us to do so. But we do open that conversation, and they are receptive. They're very open to consider that kind of thing. So and at the end of the day, I think just touch on the point about fundraising that Cheryl kind of like mentioned earlier. Of course, I agree that in this kind of like part of this period of time, if you can live with you already have enough runway and cash to survive, there's no point to go out and raise. But if you still have to do so because of whatever situation you are in, I think the sensible way is probably try to look at some raising from like home office or high net worth individual. For example, we have some delay from the previous round where people will say, okay, the market crashed, the liquidity is dry up and that sort of thing, and we have to delay the things a bit. But having a frank and open conversation get us a very good way, a good visibility on what would be coming, what would be delay, and help us to build a pipeline of activities and planning it accordingly, right? So I think there's up and down, and there's some hiccup along the way. But I think so far we managed it quite all right. And couple that with the space that we're operating in, I think we're in a fairly good position so far. And also do look through government, right? They offer a lot of help and loan as well. So like I think in the US they have similar thing, but in Australia we also have like bank open up some unsecured loan for staff, and now they kind of like looking at some sort of like special support for deep tech staff, for example, in the space of like AI, machine learning, nanotechnology, that kind of stuff. So do look at that as well. Try to have a holistic kind of like plan.
Cool. So speaking of like financing and additional financing, I guess, I mean, what as VCs, I guess, and investors, so Shao-Ning, Eddy, or Binh, I mean, can you tell us a little bit about like where would you actually double down? Especially obviously all portfolio companies need to rationalize, but what about companies that you're seeing that, hey, you know what, guys, we should really just put more money in it? Are there companies that make sense?
Yeah, of course. I can't really comment on the particular companies, right? But I think we talk about sectors or market.
Quan,
probably I think
Quan,
yes.
I think they were talking back to the VCs.
Oh yeah,
but,
sorry about that. I thought that question get back to me. My apologies.
Sure. So there's Binh, Eddy, Ng.
I was going to say, the Great Reset, some people call it, right? It's definitely interesting. When I went out to raise capital during the Great Financial Crisis, we started to raise capital 4 months after Lehman Brothers, right? So it took us almost 2 years to raise my seed round, and we ended up with a seed round of maybe 40 investors. So we were taking checks as low as $5,000, just trying to scrape any money we could. It's slightly different now, I think. There's a lot of investors out with a lot of dry capital. I mean, last 3 years, we've seen a record number of funds and a record amount of capital being raised. And, for those who don't know, venture, it's a 10-year vehicle with maybe 2 or 3 years of a deployment period. So you're on contract to actually deploy that capital. And so, I think there's a lot of appetite for deals now. There's certain sectors that are going to be, obviously really strong.
Can you
how I look at
expand
the
on
sector.
that a little bit more? That's a very popular question. A lot of people are really interested to know from an investor's perspective, what sectors do you see booming and being able to take advantage of this situation? And then there's a lot of questions around the travel industry as well and retail industry about like what investors are looking like. How are you thinking about that? Are you just not? Will you just not invest in those sectors right now, or what are you thinking?
Well, I think as an investor, you're actually in its. You find yourself in certain buckets. So at 500 Stars, we completed a survey of investors, about 140 respondents. The majority, like 83%, said they're going to be affected by COVID. And really, those buckets are either you're too busy with your portfolio companies trying to provide support and your constituents like your LPs, and so you're not deploying capital, or you're sitting around, you're observing, you're not deploying capital. Or you're deploying as you would, maybe with a different level of scrutiny, maybe a focus on certain sectors. You know, at 500 Stars Vietnam, we're continuing to deploy capital, but you know, for us, I mean, I like to look at it as like almost what hasn't changed in the world, you know, with this pandemic. And since we're long-term investors, we always think about like, hey, 5 years from now, what's that market look like? So, you know, what hasn't changed? You're going to still probably travel, you know, not right now though. You're still going to eat. You still need to buy clothes and have, you know, use the internet. So it's almost like looking at it from a hierarchy of needs, and really boil down to, you know, where areas are growing. There's also companies that are kind of, I guess, kneecapped when it comes to valuations, and there's opportunities there as well. But yeah, I mean, I think there's clear sectors out there that just really are going to be hurting. Travel is definitely one of them, and tourism.
Yeah.
Okay, so I was going to share that. So on my personal portfolio side, I have 28 companies that we personally invested. So we did an exercise about 2 weeks back, just looking at.
And Shao-Ning, do you invest in mainly Southeast Asia or US companies or both? As an angel investor, right?
Yes. Out of my 28 companies, I think the furthest I've invested, one in Helsinki and one in Kazakhstan. But these two actually subsequently gave me a lot of tax issues. So for now, my strategy will be Southeast Asia. So yeah, so that's so out of the 28 companies, I would say that about so we categorize them in three groups, right? So one group that is doing really well because of the environment that we're in. Then one group that is we expect them to drop between 25 to 50%. And then there's the last group that is more than 50% affected. So out of the 28 companies, I think we have about 6 companies that is in the first group that is actually doing really well because of the environment that they are in. And the second group is they're being affected. So that group, we actually had a one-on-one call with them to say that how are you going to manage finance and how do you extend your runway. And the last group is really asking them to give us scenarios that you're going to see 0 revenue for 6 to 12 months. What's going to happen? So we actually went through the exercise and get everybody to think about that. So actually, just now to echo Desmond's sharing. So I used to run a job portal, right? So a job portal, basically, your strategies is your paymasters are the HR people. And during downturn, actually, you have to change your focus. You're still doing the same business, but you have to change your focus. You've got to be a lot more tactical. So I think that probably applies to, that thinking actually should apply to almost all startups and all founders. How can I extend my runway by finding extra revenue? And one of my, I think my mindset, my personal mindset is slightly different from most of the startup nowadays. So background is I never raised funds for my startup. So because of that, I had the leeway, I had the freedom to really structure the business the way that we did it. So we are 4 co-founders. Between 4 of us, we came up with $18,000 back in 2000 to start it this way. So the thinking very much is, how can you last beyond the recession? So I remember during the SARS day, it was really scary because sales dropped to 0. customers were not even seeing us. But then after that, we changed our focus to focus on the startup, on the job seekers. How can we provide services for them? We can't make a lot, but the goal is to make sure that it at least cover the rent. We can't even cover the salaries, right? But at least cover the rent, and then we make sure that we continue to keep the morale of the staff high. Of course, on the cost side, I think someone was sharing about cost management. So what I did then was actually, we came up with a scheme to really shave off 20% across the board, because I didn't want to lose the good people we had then, but we need to really bring down the cost. So we had to bring it down 20 to 30%. And it's through the staff's commitment that we will push this through. So, and one key thing that I realized that banks are no help now. And to jump back to my investor hat right now, I would say that of my third category of companies that are not going to have revenue for the next couple of months, our take is we will support them, provided they have shown good traction in the previous 5 to 6 months, and that they're actually having good strategies to go into the new market again. I think the new normal is something that we don't really know what it looks like. And everybody is talking about new normal as if we know. The fact is your plans are actually built based on the previous 6 months, which is not normal anymore. So I get very, I mean, honestly, my worry goes up if the founders are still insisting on the original plan. So right now, actually, is relook the plan. How can you adapt to a new normal, which actually we still don't know what it looks like yet. So you need to be a lot more flexible and a lot more willing to experiment. And you have to be
super helpful.
You have to make very quick decisions.
I'd like to add something that echo some of what you said. I think the new normal is basically basic business fundamentals, right? It's one of the shocks that I got when I came to Silicon Valley in 2009. Very naive, didn't know much about the whole Silicon Valley thing, is that companies were raising money on ideas back then, right? And then thinking about profitability, which are basic business fundamentals, later on. Yeah, we'll work it out, right? As if that always happens, right? It doesn't, because that's great when the market is going up, but it's not great when it's going down, right? Because then you don't have any revenues, and then you're scrambling left, right, and center trying to work things out. And as you pointed out, it's like in business, you need to be always on the ball, and you need to be thinking about multiple opportunities that are coming along the way, right? I know it's traditional in Silicon Valley to say, focus on one thing, but that's great when the market's going up. It's not great now, because that one thing you might have been focused on is not going to work anymore. You need to look at multiple sources of revenue. Maybe there's a way that you can reskin your product. Maybe there's another channel that you could sell through, right? It's actually, it's just so strange for me.
Is there a concern, Ernest, that in that strategy, because I'm hearing startups doing that too, like figuring out multiple revenue streams, whereas, typically the mantra is focus on, one or two things and do it really well, right? And then now you're asked to almost like do a different strategy. Is that confusing? Is that helpful?
It's basic business fundamentals. So, when I did my computer, so I'll just give you a bit of context. Back in Australia, when I did my computer science degree, I started working for AMP Limited, Australia's largest superannuation company. And I didn't understand the business. And one thing I realized, I needed to understand business. So I went and did my MBA. And in Silicon Valley, MBA is like, no one likes MBAs, right? For me, it was fantastic. It gave me a very horizontal view across the different verticals and really understand some of the depth, especially around technology. And so my mindset from that point onwards was always different. I always thought about basic business fundamentals, which is why I got a shock in 2009 that in Silicon Valley, things run differently. To me, it was like, it felt like I'm just learning everything from scratch again. But when you look at most businesses out there, I mean, let's take an example. GM has refurbished some of their factories so they can build ventilators, right? You're hearing this of large companies out there. There are case studies at the moment of large companies that are, changing some of their processes, reusing existing systems in order to service the existing market, right? And so businesses have always been doing that. I think in a startup, land, we've been focused on, everything's been going great for the last few years. And now a lot of us are getting a shock. It's like, wow, what do we do? Well, what do? We'll go back to basic business fundamentals, right? And those things will keep you going through the ups and through the downs.
Interesting.
Now, I'm not saying you should be doing multiple things at once and be scattered, right? Let me just give you an example. We've built a project-based bookkeeping solution through Veryfi over the last few years, but we've built out these APIs, which today we sell to enterprise firms, right? And now our demand for automation has picked up because people are at home, no one's doing data entry at home, but you can use APIs, you can use machines to automate. So companies are looking at cutting costs, and then they have to move towards automation. So because we've got two product lines, right? One source of development going on, supporting both products. We're not scattered. We're still developing the same system, but now we're selling one to small, medium businesses, and then one to enterprise companies. Obviously, there are differences and nuances between them, but it's not that dramatic. But I believe that you can pick up any technology product and reshape it, remold it, just like bread, in a way that it can serve one group of people and then also another group of people in a slightly different way.
Yeah.
Is from an investor standpoint, I mean, like, is the power law still going to be effective or applicable in this scenario? Is it something that would work? And obviously, like, power law doesn't really work necessarily, given if you're trying to have multiple streams of revenue. So I'm trying to give you a counter. But
Sure.
given that startups and investment returns have always been based on, well, returns. And in the end, in most cases we've seen, power law really wins. I mean, is it still applicable now? And if you're a startup that's not on that route, does it still make sense to continue? I mean, as much as survival is one thing, and I think survival is important, what should you do? I mean, does it work? Should startups continue? What do you guys think? And and this is open for everyone to some degree. But
I don't know. My perception from talking with investors and thinking about how we approach market dynamics is that the power law still applies, but there was this kind of disconnection from reality for quite some time over the last decade, where the power law was being pursued without any interest in unit economics and was in effect kind of stealing air from the future by, even when we saw it most prominently with the Vision Fund, where it was like capital as competitive advantage. And it's been interesting to see that experiment play out. And I don't know whether COVID's probably going to concentrate the minds, particularly for the sectors that are impaired. I think for most of the tech industry, if you take, to Ben's point, the long-term view, the 5+ years, what's not going to change, that this period is probably going to be a net positive for our industry, because we are able to help people to do more, to operate remotely in many, many ways. I don't think the power law dimension necessarily changes, but it does mean that you're not necessarily going to be in a fight to be number one, where most of the benefits accrue to number one against 3 or 4 other folks that have got really messed up unit economics and really messed up go-to-market strategies that are just continually borrowing in a different form of, I mean, if you look at the liquidity preferences that stack up as folks do crazier and crazier deals for bigger and bigger valuations, there's a great article in this week's Economist that likens it to getting, it's not debt, but it operates in a similar sort of way, where you've just got this stack sitting over the top constantly, layer upon layer upon layer. So I think the fundamentals are not going to change, but in a sense, it's going to require those sorts of power law, network effect. Is it really technology-enabled innovation that has the great gross margins that the industry has been able to create returns from? Or is it actually just the same thing, but wolf in sheep's clothing, or even worse, just a bit of a hollow man situation where people have been talking about top line revenue, but all they've really been doing is taking $1,000 and turning that to $10 worth of growth or $100 worth of growth, but still just championing that $100, even though it's not really a solid business.
Yeah, I
Geoff,
think actually
while we have you on, I was curious, since you are leading the Aussie Founders Network, so I'm curious from that perspective. You know, obviously, like a lot of AFN members are Australian startups looking to expand to the US market, right? So are you hearing like things change there, like people holding back plans to expand into the US or continuing their plans, or what?
There's a huge amount of uncertainty because we're only 4 weeks, really 5 weeks into this thing. So I think that most folks are still trying to work out which way's up. Certainly, if you're thinking about expanding into the US, now is not a great time because you can't legally get into the country, and then B, if you do have a green card or some other method to get in, then you're in quarantine situations. If you're trying to raise capital and you haven't already got existing relationships with VCs, it's going to be really hard to get a deal done. I think someone else was mentioning earlier, like the first, if we're 4 weeks, 5 weeks into this, let's say we're 5 weeks in, the first 3 weeks was VCs ignoring everything new and just looking at what's the survival profile of my portfolio look like here, and breaking them into, do they need to raise in 3 months, 12 months, or later than 12 months? And then what's happened with their top line? If they're a technology for the travel industry or hospitality or events, then they're looking at catastrophic 80, 90% reductions. If they're not, then they might just be seeing 5, 10% reductions in top line. And there's the few that, we're great to have some people on this call that are actually benefiting because they're able to help in a difficult time in a way that isn't just a goodwill help, but actually helps their business grow as well. The focus on portfolio and survival meant that they weren't interested in new deals no matter what. And FOMO is such a strong factor for getting deals done has just evaporated really. Like, which VC's really worried about a term sheet getting gazumped right now or someone beating them to a deal or a close? Nobody. Like, it's just not a factor. So it's going to be that absence of FOMO combined with probably a lot of desperate folks that just assume they could keep turning $1,000 into $100 and it would keep getting funded by somebody else. Is going to lead to some very depressed valuations and tighter terms, and there's probably going to be a little bit of predatory stuff going out there as well, where things get squeezed down and compressed. So generally speaking, I think it was good advice towards the top of this call. Like, if you don't need to raise in 6 months, then don't. And then as it relates to going to market in the US market, for example, like a lot of folks that I help and advise, if you're prepared to set your alarm early, then you're really not at any disadvantage now selling from the other side of the date line to someone in New York, because anyone that they're going to be communicating with to try and buy from is going to be on a damn Zoom call anyway. So, aside from the fact that you can't solve for time zones, it's flattened the world out pretty significantly during this interim period. So I just suggest folks sit tight, focus on product market fit. Sure, diversifying your income sources per Ernest's advice is good in some respects, but I would challenge it a little bit. I wouldn't try and become something that you're like absolutely not is some form of desperate thrashing around if you can survive through and ride through by doing some of the other great advice on this call in terms of cutting your overheads, and instead just double down on product market fit. And we're actually, like in our business, we're kicking off some stuff that's internally orientated, but I think it'll actually have some pretty good external marketing benefits for us in the long term. Our customers, just like you guys, aren't commuting anymore. So we actually, admittedly, per Andy's comments at the top, we got dogs barking in the background and kids running in needing a diaper change or whatever, right? So it's more disrupted, but
tell me about it.
We actually have more time. And so we're going to be spending some time fireside chat style with a dozen or more of our clients, with all of our engineers, for example, and all of our go-to-market team in attendance, something that we've known we've wanted to do for a really long time to help nail a deeper understanding across the org about what we do to help run a professional service business and what a day in their life looks like. And we're like, well, they've actually probably got time on a Friday afternoon now that they're not doing a commute or thinking about going on a vacation or having to trudge through TSA or an airport because they're not actually traveling. So maybe there's some silver linings here to be had where it's about focusing on product market fit, focusing on that user and that customer and taking advantage of the kind of forced isolation. You know, you look at the history of some great open source technology and think, why did so much of this come from really far northern cold climates? You know, and there's an argument to be said, well, it's because it's miserable to go outside there for a lot of the year. And it's actually a productivity boost. And in a sense, we've all kind of had that forced upon us now, haven't we? So and we're lucky that we can.
Well, I think it depends. Like if you have a toddler running around, and you have to keep an eye on. I think if you have 8 and 9-year-olds, that's fine. But in my situation, it's a little different. But I want to switch back to the like Lennise and Vu actually, because I know you are both fundraising right now, like right in the middle of closing. I'm really curious, you know, how, because, you know, some people are lucky to have closed a round or can postpone a round because they haven't started. But what are you guys facing? You're in the middle of it. And have you had to, who was it who mentioned you have to change your strategy, right? Like, have you midway and be like, oh, here's the plan in this situation? Lennise, so you want to go?
Yeah, I could take on that first. So what we noticed when we're raising our round at this stage is that we notice we tend to attract more angel investors rather than VCs. I think VCs right now, understandably, are more cautious in terms of what and who are they investing in. And of course, they're trying to actually save their existing portfolio first if they can. Hence, if they were to actually look into new deals, that's probably not something that they are prioritizing right now. So we just graduated from Y Combinator, the recent winter 2020 batch. And we saw that it was the first time ever that they did an online demo day. So it's a completely different experience. Everything's on Zoom. And I would say that, like, of course, the whole FOMO and face-to-face experience, it's not available or it's not there. We can't have that same experience in comparison to having an offline demo day. So yeah, I mean, we're actually closing our round right now. So in comparison to other founders as well throughout the batch, like my batchmates, I think like we are pretty lucky we're able to do so. And I know that I think like one of the biggest and the best ways of us helping each other, like startups helping among each other, is that if you know anyone else who's actually raising, just help them out, maybe do some good introductions like to whoever they can actually speak to. They probably have spoken with like VCs who are interested to invest in this or have able to filter them better. So these startups won't waste your time talking to investors that are not like ready to invest in them at this stage, in this moment.
Mm-hmm.
I don't know.
So your valuation wasn't affected. Do you think it's because you had started like before? And if you had started like later, that might be affected, you think, or
so really? It's I guess like it depends on how the founders and also the business model and your right. A very tricky thing to talk about. It's a willing buyer, willing seller kind of thing. If you're able to convince investors that your company is valuable and there is like positive growth amidst of this whole COVID experience, like I think that's best. And I would like to echo what Geoff was saying, right? Like product market fit. And this is something that at YC we always talk about, build something people want. And during this whole COVID experience here, like what the whole world is facing is a shift of what people are investing into or what people actually want. And there's a whole lot of like other new products that you can actually create in order to actually still sustain your business or even like keep that growth number up. Yeah, so as a founder, just experiment more, build more MVPs, talk to your customers, be in touch, and go back to the grassroots and really understand what's going on within each and every one of your industries.
Yeah.
I
So if
just
you
I just want to add some. Sorry.
Yeah. No, go ahead. I mean, I was just going to echo like business fundamentals, right? Back to your point, Ernest. If you have solid business fundamentals, then it probably won't affect you around in the middle of it.
You know, so what's also interesting out of, I mean, yeah, business. It's funny story is that you know, there's a lot of stuff you read about YC online, and you know, people obviously give it. I don't want to use, you know, mention the words, but there are people that talk negatively about YC. YC is all about business fundamentals, and I'm sure Lennise, you remember as well. You know, it's either about it's some sort of a growth or some sort of a revenue figure, right? That you want to sort of stick to, and those are, you know, your business fundamentals, right? So YC pushes you towards that.
Default live or default dead.
There you go, right? And you know, I don't want to sound like, you know, I'm waving a YC flag. I should probably have the orange stuff in the back, but YC also carries a lot of weight. So the brand equity, right? And so when you're a startup after you've graduated and you go to a VC, YC's done the filtering, right? A level of due diligence, and it's very hard to get into YC. It's harder. I think it's like 2% acceptance rate, which is harder than Stanford University. So that already gives you credibility as a startup. So if you're an early stage startup and you're thinking about, should I do YC? Do it, right? Do it, and reach out to the alumni network. Don't read the stuff online. Don't read none of that stuff online, because it's usually people who didn't get in. Just reach out to the alumni network. And that's the other part about it, is the network is really, really strong. That's one thing that I've seen a lot of different accelerators try to replicate. Let's replicate YC. Well, it's the network, right? It's the people. It's the trust. I mean, the best way I want to sort of summarize that before I shut up is the first rule about YC is you never talk about YC. It's like the Fight Club, right? It's a very tight community. But it's obviously not a Fight Club, but it's just really tight. Yeah. And I think,
Thank you for that YC
I'll
plug.
mute myself now.
No, it's okay. I wanted to make sure Vu had a chance to speak, and also Tiger from the founder perspective, and then we can maybe, because we are, and I want something to share too from the Indonesian VC perspective, a few that hasn't spoken yet. So Vu, you want to go ahead?
Yeah, we definitely are in the process of fundraising for our Series B right now. And the reason we decided to do so, even though we still have about 14 months of runway, is we actually already had some of these conversations started. And for us, I think it's a matter of like some of the investors that we don't have the relationship with, and we know them before. And also at our current stage, it's all about the numbers. And so given that we feel like there's a chance for us to raise, and instead of waiting for a lot later, because you don't know how long this recession is going to last. It could be towards the end of the year, it's going to be even worse than now. And so by then we're going to cut closer to our end of runway, versus now we still have about 14 months. So it's a lot less stressful to raise now. And so that's why we decided that why not, we can raise now, we should go out and raise it. What we have seen is that definitely the conversation, it moves actually really fast. VCs are very efficient because they don't want to waste our time in this COVID-19 challenges. So if they want it, and they're very transparent, if they're not investing, they will tell you they're not investing right now. And if those who are actively investing, they move actually even faster than what I usually see from previous conversations. But what I think from all of the other founders that are raising that we see is that investors will be doing a lot more diligence on the numbers than they would have done on a normal situation. Like they make sure that, hey, all of your numbers, the unit economics have to be a lot more solid than it would usually require. So lots of numbers back and forth on the due diligence that we see, at least here in the Bay Area, compared to previously. So for founders who are ready to raise, definitely put a lot more numbers in your data room than you would usually do, because that would just going to make your process go a lot faster and be more efficient in that process. I think what Ernest said is definitely a network of founders helping founders. So figure out who in your network founders are raising and share the notes, right? Like if that VC is definitely not raising, not actively investing, they're gonna share with you so that you don't have to waste your time going through that as well. So we do a lot of that notes exchanging and say, hey, we actually talked to that VC, and yes, they're gonna go through the process, but at the end they say, hey, let's wait until the fall so that things get better. So those are some of the insider information that you want to get with your founders, because then you don't want to go through that process for 2 weeks just to know that they're not going to invest in you, because not because of your performance, but because that the fund is a little bit more holding back right now. So I think those are the few things that we do for founders who have closed, at least at our stage. We do hear that the valuation do go down about 10 to 20% compared to what they would have wanted at the beginning. So that's for the founders to also make the decision. If you were to raise now, are you okay with that 20% down in valuation versus you wait for 6 more months? Now, there's no guarantee that 6 more months situation is going to get better, because nobody can predict this recession. And so could be 6 more months, your valuation is going to go down further because the situation gets tougher. So that's a tough call that I don't think anybody can give you advice right now. I don't think even VC can really tell you. So you just have to make the decision whether you want that route currently or not, or if you want to wait for, I think if you have 18 months, I think that's a lot safer. I think anywhere less than 18 months is probably cutting a little closer. And so you're going to make the decision right now. But valuation in the short term, to be honest, is not going to be the top worries that you have. I think if you continue to do well, 10%, 20% right now is not going to make it look bad in the future. So giving all of that information, that's why we decided that, hey, it's not a bad time to raise. And I think the process hasn't been as bad as we had thought going in.
Yeah, that's really cool that these are actually moving quicker. That's a big plus. Thank you for sharing, Vu. I guess we can take maybe the last 10 minutes to chat about Indonesia, between Eddy and Tiger being the largest market in Southeast Asia. Do you want to share, just like, feel free to share any perspectives, no specific questions, but from the Indonesian side, Eddy and Tiger.
Hey guys, maybe I'll go first. Just a quick introduction, so I'm a little late. So we're Kargo, we're a Series A sort of stage trucking or market logistics marketplace, sort of like Uber Freight, Convoy in US, FTA in sort of China. We're very lucky to have raised sort of our A round right before sort of everything kind of went sideways. And I think to a lot of you guys, having enough balance sheet or having enough capital in your balance sheet is just super important. Allows us, we're very lucky that all of us can work from home. That's just not case. That's just not true for 99% of the world out there, right? And so our truckers, the guys in the field, they have to be still out there. And sort of this has actually been a very clarifying sort of process for us to our mission. And we used to do a lot of things. And I heard from Ernest, I think I agree with you. You have to diversify your revenue base, but we actually dropped a lot of our side projects, almost every other sort of things that didn't sort of focus on the core sort of delivery business. And we focused everybody to now go and find critical suppliers of goods. And we're importing masks from China and ventilators from China to Indonesia, because this is first and foremost just a humanitarian and social crisis. And I think there's administrations around the world that are talking about reopening borders and restarting economies based on points of the Dow. This is like we have to focus on making sure that countries, especially these developing countries, survive through this humanitarian crisis. And then we have to, just Kargo and our whole company, we're just completely focused on making sure that we can deliver these critical sort of items throughout Indonesia. And that's sort of really been the focus for us. We're very lucky to be able to do that because, number one, we've raised money and we can work from home. And I think every time I talk to Eddy, who I love to hear from, I'm asking him for more money. So this is the first time I'm actually sharing sort of a conversation with him. That's outside of that, but just I think just making sure that we're doing that sort of and making sure this country survives is way much more important to us, because if everybody's dead, there is no economic recovery. So I think we see sort of this fundraising environment just completely flip overnight. We had an oversubscribed A round And because of this crisis, we went back to the market to say, hey guys, I know we couldn't let you in, or we had to really cut down your sort of your allocation, but we're taking all the money we can at the same valuation, and we're just seeing a complete 180 from guys that have a lot of cash on their balance sheet, right, and a lot of dry powder. And so one of the things that we're doing is having those conversations again, and really pulling out all of the metrics and data, as as some of you guys suggested, on sort of unit economics is really all about unit economics these days. And when we're showing positive unit economics, people are still afraid to really to sort of pull the trigger. And so what we've really focused on is just the 1 and 2, the guys that really have conviction, in your mission, in a team, and folks like, we're lucky to have on our cap table like Sequoia and Intudo, and we got them to commit, and we said, hey, look, we're leading this extension no matter what, and you sort of come in, if you sort of believe in this mission, right? And you sort of know who, when all of this sort of cuts through all of the the BS that happens when fundraising, the people that really support you will come through, and obviously. Eddy has been very lucky to have him, on our side, and sort of being able to lead a lot of these conversations. But yeah, Eddy, can you give us more money, please? Thanks.
Yeah. So it's like, okay, Eddy decided to invest in your startup with the same valuation as an extension. Eddy, have you declined startups that have come back to you? Yes. Without the proper fundamentals.
We've been pretty fortunate. What do you call it? A lot of our businesses, granted, we start a little bit later. We run a pretty concentrated portfolio. We do about a deal a quarter. So it's really business as usual. Our total portfolio is 19 companies. Every single one of them sits in Indonesia. We visit them every week historically. So now we just do it through Zoom. In terms of my companies, it's not that they're good. It's just in part, certainly guys with Tiger, but in large part, a lot of it's like luck, in that a lot of our companies just happen to be on the right raise cycle, in that we raised capital, call it in the second half of last year, or the first quarter of this year. I like to say for every, call it business model, if you will, business that say in Indonesia, there may be 3 to 5 legitimate companies that we respect. Maybe in the US you have, call it 30 to 50, or let's say in China 30 to 50. So if your competitors just happen to be on the wrong cycle, weren't in the market at the right time, they're kind of like Michael Jordan getting injured in Game 7 of the NBA Finals, right, in the first quarter, where you just happen to be on the right cycle. You're going out to a market where, frankly, in Southeast Asia, or Indonesia in particular, I would see you've never seen a down cycle for venture. I mean, it really started in 2012, right? So only one direction, where investors historically, would sit in Singapore and fly into 7 countries, which I think was a necessity in 2014. But a couple of years in the ecosystem, realized that the only market that matters in Southeast Asia to build a venture scalable business, at least for consumers, Indonesia, given that represents 45% of the population, 45% of the GMV. Otherwise, you got to piece together 4, 5 independent countries. So for us, we have not said no to any of our companies in terms of have come back. That said, most of them raised, call it in the second half of last year or the first half of this year. And our, from a cash position perspective, have capital through the end of next year, if not longer. I mean, in Tiger's case, it's certainly several years. So I think a lot of our companies, we're instructing them to be a little bit more offensive in this situation. If there really is only 3 to 5 legit companies, if we're one of the 2 well-capitalized companies, and this is not just the pandemic. I think this is a function of, we started seeing this in Q3, Q4 last year, post WeWork, et cetera, where, historically investors invest like, they're like sheep, right? Fear, greed. And, I did that myself in 2000, 2008. But, one thing that, my partners and I promised ourselves is that, we've invested in real business. So our public PR for the last 3 years is profitability. 20% of our companies are net income positive. And the ones that aren't, if you pull out marketing, pretty much for the most part, they are profitable. So that's what's, at least for our firm, it's quite different. So we've been very lucky. We run multiple analysis, matrix where, let's say revenue goes down to 0, it goes down by 50%, 25%, OpEx and marketing. And, the way I like to think about it is every one of our companies, we've zeroed out the revenue. And for the most part, as long as that can take them out 15 months, if you make it a net revenue exercise, in many cases it's 2 years, 3 years. We have some companies with 4 years of cash. So they're playing a little bit of offense in this environment where their competitors just, are on the wrong side of the, in terms of when they go to the market. So there's a lot of unique opportunities for consolidation where we can pick up companies, for the cheap, for, some stock deals, or just pick off their employees, or pick up their customers. So at least so far so good. That'd be my feedback.
Wow. Yeah, actually, so at SVB, we get a lot of data on startups because we bank more than half of the venture-backed startups in the US, and certainly from Global Gateway, a ton of global cross-border companies too. So even from like at the end of last year, one of the trends we're seeing is that a lot of funds and VCs are already telling their founders to raise money last year, actually, like in terms of how they're predicting without the pandemic, obviously, that in 2020, funding will significantly shrink anyway. So it's funny that, like, you know, this pandemic has accelerated that like 10x, right? And the other trend was that that we saw at SVB was that there's a bigger gap happening between first-time founders and repeat founders getting first meetings with VCs, and how that was already happening all throughout last year. And now it's, with the pandemic, it's even, again, like 10x, right? If you're a first-time founder, it's harder to get that first intro to the VC unless you've been introduced by a founder friend. I want to, there's 3 minutes left. I wanted to open up to the panelists in terms of like what, oh, hi, Binh's daughter is on too. What behavior, there was one question that someone submitted through our portal, is what behavior do you think will persist post this pandemic, like, and will be a new normal? I know it's hard to predict, but it's just a fun question for, like, no more handshakes. Someone said namaste, you know, is the future. Just anyone jump in to kind of cap it off. What social trends or even business trends you see being the future? I mean, someone mentioned work from home as one.
So we have a little over 60 companies in our portfolio, and the ones that are kind of winning, folks at coffee, obviously e-commerce, social gaming, remote engineering, companies that are pivoting to kind of like touchless society, contactless. and contact, yeah, and then therapy.
Telehealth, yeah. What social norms are gonna go away? Like, are we not gonna hug each other anymore? Well, anyone else?
I definitely want handshakes to go away. I think we spread way too many viruses through shaking. I much prefer to do the Spock way of hello, or maybe the Japanese way of bowing. I like that's respectful. But I think the handshaking, that's just old school from medieval days when we showed we don't have any tools in our hands to kill each other.
Well, it's handshake, but in the US, you also hug each other, right? Which is even more, or in Europe, and we kiss.
Yeah, if you know someone a bit more, yeah. I think the Italians do the most hugging. A lot of Europeans.
That didn't work out so well, did it?
Yeah. I hope more businesses start thinking about going back to business fundamentals as well. I think that's going to be important, because we can't always be optimistic. Sorry, we can always be optimistic, but we can't always have an environment where everything's trending up, right? We're going to see that quite a lot. And I think we've been seeing a lot of that over the last few years. So going back to business fundamentals, so more businesses can survive, and maybe it's going to put a bit of, people that want to become a founder will stop and actually think about, what does it really mean to be a founder? Is it because now I call myself an entrepreneur, or is it because I'm actually going to go and run a business, right, and make a difference and add, value to shareholders and so forth? I really hope that will change as well, because I feel like in the last few years, there's been way too many people jumping into the whole startup game because they want that fancy title. It's not about that. It's actually about,
it's actually hard work, right?
It is.
Shao-Ning, you unmuted. You want to share something?
I wanted to echo Ernest's point that I think this is a good time for us to relook what is a good business mindset. I think the past few years, because of the flying valuations, or because it's fanciful to be called a founder, we have a lot of business founders building the wrong habits. The business habits are to build market share at all costs. You don't care about cash flow. You can spend $4 to earn $1, sometimes $4 to earn a couple of cents. So we need to go back to fundamentals, and then we need to relook what is the business mindset that we have. I think we need to bring people back to earth. And one thing that I thought that is going to become a normal behavior is actually telehealth. It's interesting to see the number of people really jogging on the street, even though we have a circuit breaker in Singapore. More people are exercising now, regardless of what's the weather out there. And I actually see people jogging in the rain. And I think it's just the fact that you're being cooped out at home that it makes you realize that you need to get out there. And I think it's actually really nice that I literally hear birds chirping in Singapore. I mean, you know, Singapore is a city jungle, but the birds are chirping now, and you know, the nature seems to be a lot happier without us out there. So I think we need to relook how we are treating the whole environment issues. So that's actually one thing our habits I think will change too.
And I think piggybacking on that, there's going to be, I'm already seeing it socially and professionally, a lot of the things that people get bent out of shape about, whether it be, you know, people having feuds online or culture wars in the political domain, or none of that shit matters. It's a complete waste of time and energy. It's like people spending more time with their family or missing their family more. People not having the liberty that they're used to having. I think there's definitely a positive dimension of the centering that will come from this, and might wash away some of the BS that that has certainly distracted a lot of folks. Then conversely, folks are spending a lot more time inside watching YouTube and Facebook, so maybe they're just going to come out of this more paranoid and argumentative than ever. But I guess we'll see.
But I like that we're all ending on a positive note. I mean, I did see on TV just the other day that 65 people are working out 65% more or something. So to Shao-Ning's point, I like that we're all talking about like the fact that we are forced to go back to business fundamentals and what matters. We're forced to, you know, hopefully not forced to, but we are spending more time with family and loved ones. We're going back to the basics, right, all around, and we're focusing on health and loved ones and unit economics, right? Everyone take note. So with that, I'd like to again thank you all, my wonderful panelists, for being on board. And I know it's a lot of people. And you know, at first Janssen and I were like, oh, maybe we have too many, but we, you know, APAC is a huge region, and plus cross-border companies too, and we really wanted to hear different perspectives. You know, previously we've heard a lot of webinars from just VCs and whatnot, or just startups, but I think this is a really interesting, well-rounded perspective globally, right? APAC is, and the US combined is half the world almost, right? So with that, again, thank you. And thank you, Andy, for my boss at Global Gateway, for being so supportive of this roundtable discussion, and everyone else. And with that, I will end the webinar, and I will send this to everyone. Thank you again, and have a good night and good morning in Asia.
Peace out. Bye-bye.
Thank you. Take care.
Bye.
Have a great night.
Bye, everyone.